Morning, Steve Reed with the morning grain comments. Markets overnight are lower. Early yesterday, the calls were higher, looking at the lower crops in Brazil, both corn and soybeans. The war continues, and there's expectations that Ukraine corn exports could maybe be less than what some people had thought. All these things could increase U.S. corn and soybean export demand and lower the carryouts. Also looking at the possibility of late planted U.S. corn crop, and that parts of the U.S. southern plains looks to be drier than normal down the road. The 6 to 10 day and the 8 to 14 day maps all show normal to above normal precip. So May is going to provide some shower activity across the Midwest that, number one, could delay planting, but could recharge soils for later on. Our forecaster believes that the overall weather pattern in the U.S. changes June 1st, and that we start going into a drier and warmer pattern starting in the southern plains and then extending into the western corn belt later this year. Some people think that the rains could lower corn acres a million and could lower the yield below the 180 threshold that we need to satisfy demand. So I think long term, when we talk about $8 July corn, we're at a key support level. We tested $17 beans, but we backed off to that price level, and we're back to some levels that are probably supportive given the fundamentals. And in the wheat market, heading back to key support in both Chicago and Kansas City wheat. The only thing that we saw in the commitments to traders report is that the funds sold corn last week. So with the stock market higher, with the dollar higher, with crude lower, most commodities, gold, silver, copper lower, grains lower, seems like a risk-off day in front of the Fed potentially increasing interest rates. The key is whether or not they're going to increase rates 50 basis points or whether they increase to 75 basis points. And everybody's going to be watching the terminology if they're going to continue to show higher interest rate, despite the fact that first quarter GDP was negative. And the definition of a recession is 2 straight quarters with negative GDP. So the economy is slowing. Personal income is declining because of higher food prices, inflation, higher energy prices, and so all that could slow demand. So the Fed action could have a negative impact on long-term demand. As always, these are my thoughts and not those of ADM Investor Services. Have a safe and profitable trading day, and remember, always treat people like you yourself would like to be treated.